We probably have the most clearest certain path of any of the lithium producers. We have 2 operating mines, we have the rock in the ground and a lot of it. We're in the right jurisdiction and we've probably got the 2 best hydroxide operators in the world with Ganfeng and Albemarle.
Welcome back to Rockstock Channel and thanks for checking in. In this second installment of Freebird Lithium, I argue why I believe Mr. Market is substantially undervaluing what is today a top 5 lithium business globally, and that the steps Mineral Resources continues to take with their lithium business, including a potential spin-off, could cause a significant re-rating in the share over time. As always, please note, I am not a financial advisor and nothing I say should be construed as investment advice. Please do your own research and read the disclaimer at the end of this video or on RK Equity's website. MinRes has been a top 5 lithium holding of mine for over 5 years, and I expect it will continue to be over the next 5 to 10 years. Billionaire Managing Director Chris Ellison is one of the most astute business builders and deal makers I've seen in the metals and mining space. As founder and top shareholder with some 22 million shares, or 11% valued at over $1.2 billion, I sleep well at night knowing his and my interests are aligned. In a market characterized by extreme volatility, MinRes has been one of the least volatile ways to hold lithium exposure during the tumultuous boom-bust years as Lithium 2.0 transitioned to Lithium 3.0. But that was largely due to being better lucky than good. Min's performance was largely driven by an iron ore boom. MinRes largely has 3 business units: its core mine services business, an iron ore business, and a lithium business. It is also a highly successful mining venture capitalist, which I'll discuss in a second. Until recently, MinRes traded as an iron ore stock. Min's stock correlation to the iron ore price was 90% over 5 years through June 2021. I won't cover Min's iron ore business in this video other than to say it has announced major investments that should substantially improve the quality of its iron ore resources and logistics infrastructure. This should insulate the company in future years from extremely volatile profit swings as it experienced in the second half of last year. I also won't speak much about the mine services business except to say that this core business is much more stable than volatile iron ore. MinRes earns steady, if not stellar, margins in up and down cycles from this business. It has life of mine contracts to crush and screen ore on behalf of major miners throughout Australia. The resulting quality, predictability, and growth of these cash flows, in my opinion, deserve a double-digit EBITDA multiple. On lithium, I start with MinRes's great success as a lithium venture capitalist. It is part of MinRes' strategy to incubate early-stage mining projects, monetize them by partially selling down its equity interest, and then maintaining ongoing upside through life-of-mine servicing contracts and joint ventures. At Mt Marion, MinRes took advantage of a Ganfeng vulnerability in 2015. Tianqi and Albemarle stopped selling spodumene to third parties from Greenbushes, the only producing spodumene mine at the time. Earlier this year, MinRes selected for the first time to exercise its joint venture right and take 51% of Mt Marion spodumene. This resulted in an incremental $500 million in revenue and $150 million in EBITDA for MinRes that no sell-side analyst had in their forecast due to tolling volumes through Ganfeng. At Wodgina, MinRes sold a 60% stake to Albemarle in 2019 in return for $800 million cash and 40% free carry in 50,000 tons of hydroxide from Albemarle's Kemerton facility. I suspect MinRes will have a third success with their recent investment in Global Lithium Resources, led by Ron Mitchell, formerly of Tianqi Lithium. I have discussed in recent videos that the balance of power in the lithium market lies first in controlling the upstream resources, and second, integrating to downstream chemical production. Elon Musk was right to compare lithium to software, but the biggest money printing machines are those doing what he described as the relatively easy part, the mining. A lithium refiner without its own supply that must compete for scarce raw material will likely achieve low margins more like traditional auto OEMs. A reflection of this dynamic is that Ganfeng, again vulnerable with hydroxide orders from Tier 1 auto OEMs, but short spodumene feed, earned about 15% margin, while MinRes is earning 30% on their tolling arrangement. Ganfeng's relatively high double-digit margin, I suspect, is a reflection of their rarefied position as a Tier 1 qualified supplier, meaning MinRes's margin was earned on super high spot pricing of about $77,000 a ton. The current Lithium 3.0 boom is a revenge of the miners story, a story being written substantially in Western Australia, principally in the Pilbara. A major plot of this story, as I see it, is one of spodumene duopoly, comprised of disciplined, rational actors, Pilbara Minerals, and the Marble joint venture of Mineral Resources and Albemarle. The Marble JV's decision to mothball Wodgina at the end of 2019, combined with Pilbara Minerals' distressed buy and immediate mothballing of Altura at the end of 2020, set the stage for today's spodumene shortage and panic buying reflected by a repeat $7,000 price at Pilbara's regular BMX auctions. The market intelligence Mineral Resources and Pilbara have resulting from their offtake and joint venture partners in China and ex-China is second to none. I started preparing this video in March following MinRes's half-yearly results. Following my commentary is 10 minutes of excerpts from that February presentation focused on MinRes's lithium assets and strategy. On August 29th, Chris Ellison and team will update the market again with a lot more detail about full-year earnings and corporate strategy. I speculate we may hear more details about the restructuring of the Marble joint venture with Albemarle, including MinRes taking back 50% control of Tier 1 spodumene mine Wodgina. Could a demerger of lithium also be on the cards, as speculated last November? Meantime, in February, MinRes laid out a strategy focused on converting 100% of their spodumene to lithium hydroxide over the next 5 years. At that time, MinRes would have effective equity interest in 100,000 tons of hydroxide exposure. In my opinion, lithium equities broadly are pricing in too bearish an expectation of where lithium prices will be in 2023, 4, and 5. EBITDA multiples for Albemarle and Livent are below historic norms, most likely reflecting a belief by Mr. Market that we have somehow reached peak pricing or peak earnings. We believe reality is much more bullish. As per our recent videos with Rodney Hooper, RK Equity sees a structural lithium deficit as far as the eye can see, implying that prices will have to remain stronger for longer. I predict that very soon, investment banks who have been much more credible commentators and big capital raisers in lithium, that is not Goldman Sachs or Morgan Stanley, will publish industry updates with new price decks, which will translate into earnings upgrades and higher stock price targets. I see plenty of upside in MinRes in the near and medium term based simply on price and volume growth of its lithium business. Relative to its peer producers and developers, MinRes has perhaps the greatest combination of organic growth, super low execution risk, and zero sovereign risk. There's huge scope for improved understanding from investors and the sell side from the huge incremental earnings from Ganfeng hydroxide tolling. Likewise, a renegotiated and expanded joint venture with Albemarle should be highly accretive to MinRes. My main Freebird lithium thesis for MinRes is that the company will, over time, trade in line with its lithium business, in the same way that Albemarle, which also has bromine and a catalyst business, trades as a lithium stock. Further, because MinRes's unique positioning in both owning Tier 1 spodumene assets and being exposed to the most highly valued lithium hydroxide market from the two leading qualified hydroxide producers, its earnings should be valued the same as Albemarle and other specialty chemicals producers like Livent, Tianqi, and Ganfeng are valued, which is a huge contrast to the current sell-side narrative and market valuation of MinRes business, which treat it as little different than iron ore or other bulk commodities. MinRes's target of 100,000 tons of lithium hydroxide exposure in 5 years is approximately what Albemarle currently produces, and is nearly 2 times what Tianqi currently produces. MinRes's market cap today is just $8 billion US. Albemarle's market cap is 4 times as big, $33 billion. Tianqi is 3 times as big, $25 billion. I'm a huge fan of Pilbara Minerals, who own 100% of their 2 spodumene mines and are currently the swing spodumene supplier as they bring uncontracted ex-Altura tons to market. Pilbara today is about a $6.6 billion market cap. MinRes at $8 billion is just 20% higher than this, despite having two substantial non-lithium businesses and what I consider to be equal, if not better, lithium market positioning as an integrated spodumene to hydroxide player with both China and ex-China partners. MinRes's EBITDA is expected to be twice as big as Pilbara's in coming years, according to Matthew Friedman, an ex-Goldman analyst who recently initiated coverage of both Pilbara and Mineral Resources for independent sell-side research firm MST Emerging. If you'd like to dive deeper into our analysis about Mineral Resources and other battery materials companies, please consider becoming a Patreon sponsor at $300 a month level, which will include one-on-one calls with Rodney and me and other proprietary research. And with that, let's have a listen to Chris Ellison and his team from last February.
Lithium is a new gold rush. With Wodgina restarting and Mt Marion thriving, we've got two of the best hard rock lithium deposits in the world. I'll certainly see out my lifetime. The whole world is trying to achieve net zero and decarbonise as quickly as possible, and we have what they need to achieve it. MRL will have the first lithium hydroxide plant in Australia, owning the whole supply chain from digging it up from the ground, literally from pick to product, is unrivaled. The world will know we're a key lithium producer, and they'll know that we're one of the best.
With our sustainable approach and our foothold in the spodumene and lithium hydroxide market, we're poised to play a meaningful role in decarbonisation and electrification. Safe, sustainable, innovative, agile. MinRes is achieving what most businesses aspire to achieve.
We've probably got, without doubt, two of the best hard rock deposits. They are actually tier one mines, and they're owned with two extremely good joint venture partners. They're in WA, so we're in probably the most socially acceptable mining jurisdiction in the world, and probably the best, the safest. We've got a secure government. We're in a great location, and the weather's manageable most of the time. As MinRes, we're targeting over 100,000 tonnes of lithium hydroxide production within about 5 years. We've got locked in capability in terms of our joint venture partners are probably the two best hydroxide producers in the world. Lithium business has changed substantially over the last 6 or so months. It's a big business, it's world class. We're just getting, as you're aware, we're just getting Wodgina going. But we've sat down with Albemarle and we've had a look at how we can get the most out of this joint venture. And we're exploring the opportunity of MinRes moving back to 50-50 ownership at Wodgina, and we'll take up the management there. It was Mineral Resources designed that plant and the infrastructure. We built it, we've operated it, it's our core business, so that's kind of where we belong. We can deliver an extremely good operation to the JV for the next 40-50 years. It's a big oil body. Kemerton remains the same. The hydroxide plant stays 60-40 ownership. The offshore hydroxide, all those plants will be built to consume all of the Wodgina feed, and we'll continually just grow those out as market demand. All of the hydroxide, responsibility of Albemarle to manage those, and also they are responsible for all the marketing and all the sales. Feed for Kemerton plant, that's all coming out of the Greenbushes mine. The Mt Marion operation, we're just taking back our 51% offtake. That's been going to Ganfeng since the mine opened. We're taking that back as of 1st of Feb, but we've also entered into a toll treating agreement with Ganfeng in China. So they're going to treat all of the that spod that's coming out of Mt Marion for us, and that'll be jointly sold into the market. And we're expecting first sales around about May this year. Mt Marion growth, look, we're running at about 450,000 tonnes a year down there. We're going through a pretty average part of the pit at the moment. We have to do it. We've got to get that out, and we're doing a couple of studies down there. One of them is what we call yield enhancements. That's probably going to give us about a 10 or 15% increase in product. And then the second thing we're looking at doing is installing a plant to treat what we call the contact ore. So the contact ore, it's found at the outer perimeter of the ore body where the ore body meets the waste. It has a reasonable amount of basalt in that material, so we're going to put a plant in that's probably capable of about 1 million tonnes a year of feed, but that's subject to test work and us getting the results that we expect we will. We'll keep you informed on that, because if that goes ahead, and most likely will, it's going to increase the product volume substantially. Lithium growth, train 1 turns out 250,000 tonne of 6% product. Trains 2 and 3 are sitting ready, willing and able to go, and we'll restart them in line with market demand. Kemerton hydroxide, we're expecting first sales late 22. There's some work to do with these hydroxide plants. When you get them going, you've got to get the material running through them. It takes a while to commission them, and then once you do that, you've got to make sure that the customers are happy with the material, so a little bit of time. Train 2 is going pretty well, and mechanical completion 3rd quarter of this year, and it'll just follow the same process as Train 1. And offshore hydroxide, that's going to be jointly developed between Albemarle and ourselves, and we'll proportionately fund that 50-50 each, and those plants will consume 100% of the Wodgina spod. In summary, on the lithium business, our aim is to be up around about 100,000 tonnes of hydroxide production in about 5 years from now.
Wodgina, how quickly can you ramp it up? Given Albemarle still has the marketing, can you sell it to third parties, or is it only going to ramp up in line with internal consumption?
We're certainly going to have product going into downstream plants, and Albemarle is sort of working on securing those. So when the time's right, we'll be able to come out and tell you exactly what those plans are, but I'm not sure that we really want to go and have our competitors understand exactly what we're doing. There's 2 prices that sort of drift around. I mean, we have the other producers, we have long-term models that they basically go out and they use the carbonate and the hydroxide prices from around the world to come back and tell us what we think the market value of this product is. So we're all generally contracted in that way. The contracted price probably sits somewhere between $2,000 and $2,400 US a tonne. I remember when it last got up to about 1,300 a tonne, and we were extremely happy with that. Then it was down below 400. We've all seen commodities that go up like skyrockets. I mean, there's probably only one way for them to go eventually, but I don't think this is going to have a crash landing. I think that there's clearly out there since COVID come along. I mean, a couple of years ago, there was a handful of car companies making electric cars. Today, if you're not making an electric car, you're not going to be in business. So I think the supply-demand chain is very different to what we've seen, and I don't think there's any doubt that year on year for the next 3, 4, 5 years out, the demand for lithium is going to continue to grow. Even if lithium's selling at 3,000 a tonne for the spod, it doesn't move the dial that much on the end cost of an electric car.
Are you thinking about this period differently to make sure 18 months from now we don't have a sharply falling price?
We're starting train 1 at Wodgina, and we're going to do a watch and see what happens with the market. We have the capability of turning on 3 trains up there. We're not doing that. We're just going to take this slowly and make sure that we get it ramped up properly. The most relevant, if you own the rock in the ground, then you own and control your future. Our aim is to get all of our rock converted to hydroxide as soon as we possibly can. We probably have the most clearest certain path of any of the lithium producers I know of to get to where we want to, because we have 2 operating mines, we have the rock in the ground and a lot of it. We're in the right jurisdiction where we're probably going to have least disruption, and we've probably got the 2 best hydroxide operators in the world with Ganfeng and Albemarle. And we are going to build those plants, and we're going to do it as quick as we can.
To building plants outside Australia with Albemarle, where that's most likely to be, is that Europe, North America, Asia?
There'll be some in Asia, there's no doubt about that. Through their marketing arm, they're still trying to understand where the best places are to put them for the future.
Could you talk about the use of the offtake from Mt Marion after the tolling agreement with Ganfeng?
Our first priority again has been able to make sure that We changed that part of their business. We wanted to get that offtake back, and then we wanted to get that that agreement in place with Ganfeng. That's a starter. Basically, an interim agreement that'll give us some breathing time, so that we can work out whether we can extend that with them. Pretty sure we can. They've said they'd like to, but that's as far as we've got so far.
You know, in terms of a kind of realised price for spodumene for you, how that might change as you go to a tolling agreement?
The simplest way to think about it is we continue to sell the spod at market, and then we take a clip on the hydroxide down the track.